Income Tax Act 1961. Lesson 5. Computation of income from salary and income from house property. Good morning, everybody. I am T.B.Agarwal speaking from Agarwal Income Tax Tuition classes, Akola. In the preceding lessons, we have studied the basic concept of income tax. To recapitulate what we have learned, we may repeat the lessons we have studied just to reinvigorate the memory. We have seen what is income, gross total income, taxable income, assessment year, previous year, casual income, person, agriculture income, heads of income, and also the incomes which do not form part of total income. For the students of BCom Part 2, Semester 4, there is one paper of income tax and auditing, and for BBA Part 2, Semester 3, there is a paper of direct tax law in some of the universities, and 5 units are prescribed in the syllabus for these papers. One question out of these 5 units is from basic concept mentioned above, carrying 15 to 10 marks. The next question comes from Unit 2, which is on computation of income from salary and income from house property. We have already completed the course of Unit 1, so there may not be any difficulty in solving a question from Unit 1. If there is any difficulty, then please write in the comment box so that it can be discussed in the next lessons. In the coming lesson, we will study the computation of income from salary and house property. It may be mentioned here that the detailed study of these two heads seems to be somewhat complex, particularly about perquisites in salary, but students are required to solve simple questions in the examination carrying 15 marks on this unit. We will first take income from salary section, that is salary section 15 of the Income Tax Act 1961. Salary is one of the 5 heads of income as per section 14 of the Act. It is described in section 15 to 17. Under section 15, it is described as to which income is chargeable under the head salaries. Section 16 describes the deductions to be made from salaries, and section 17 narrates the definitions of salary. Perquisites means allowances or something in addition to regular pay, and profits in lieu of salary. Only these 3 sections cover up the computation of income from salary. We will just discuss the word salary as it is necessary to understand the concept of salary. In general parlance, we understand that salary means the amount received for services given by employee or a servant. But in legal terms, to constitute salary, there must be a relationship of a master and a servant, or a employer and employee, between the pair, means who gives, and the payee, a person who receives or who is paid. The employer may be any individual, firm, company, central or state government, AOP, corporation, local body or public body like this. Likewise, the employee may be working in India or abroad, and she may be a full-time or part-time employee. Basically, there is no difference between salary and wages. Further, salary can be received from one or more employers. The salary may be given by the employer as tax-free, that is, tax being paid by the employer, and may be given as a perquisite or a gift to an employee, but still it will be taxable. The Act does not make any difference between payment which may be without reason or may be contractual. In the same way, if the employee forgoes his salary, saying that he does not take it, still the same is taxable. Salary is chargeable to income tax on due or paid basis, whichever is earlier, without taking into consideration the method of accounting, if any, followed by the employee. That is, sometimes an employee maintains books of accounts for himself to know the income and expenditure during the whole year. Here it may be stated, just for information, that there are 2 types of methods in writing account books. One is mercantile system and the other is cash basis system. Salary income is taken into account irrespective of the method adopted by the employee. Salary is taxable when it becomes due to the employee or received by him, whichever is earlier. That means if the salary becomes due but not received by the employee, still it is taxable in the year it becomes due. Or if the salary is paid in advance, then also the same is taxable in the year of receipt. Though, however, it may not be again included in total income when it becomes due to the employee. Salary is considered for the months of April to March or March to February, depending upon when it becomes due or payable. However, in case of government employees, salary for the months of March to February is considered. The basis of charge of salary is fixed under the section 15A of the Income Tax Act. All the payments received by an employee from employer are taxable and includable in the income of the assessee unless specifically exempted from tax under the Act. If you like this video, then please press the thumbs up icon and subscribe this channel and press the bell icon next to it for getting the notification of my next video. And we will also learn more in the next coming videos. Thanks.